So we're doing the cost statement. In the question here, or normally in this book, they ask the question in this way that prepare a statement of cost of goods manufactured and then prepare an income statement. So it can be done, like we can stop our cost statement at a particular point, like let me show you. Like if we want, we can finish our cost statement at this point, cost of goods manufactured. Okay, and we can put the remaining sections into an income statement. Income statement, we know how it is made. Income statement has income on the top, expenses on the bottom. Expenses are classified into cost of sales and operating expenses, and after that you have a profit. So if we know that format, we can enter the items into that too and create it if we want. Whereas we have created in such a way that it only shows the cost. So by keeping it in this way, you only see the cost. And let me show you. Okay, so we only have the amount and the costs here. What this kind of cost statement will do, it will show you the total cost of the product for the year. So once you have every cost accounted here, you can have the number of products manufactured or number of units manufactured to determine what the cost is at each stage. So if we had it in last problem, no, we don't have the number of units, so won't do for the last one. This one also doesn't have it. Okay, so we will solve number 3. So we'll start solving for number 3. And just put the number of last problem here. Last one was the exercise C on page. Where is the page number? 20. On the bottom. Exercise C, page 20. And the one we're going to solve now is problem C on page 20. It starts on page 20 and 21. So the question says Good Vibrations Incorporated has all this information, and we are supposed to make the cost statement. So we'll give the title or statement the year ended or for the period ended, we'll have to write here. So what's the period of the statement? 31st December. So cost statement for good vibrations incorporated for December. Create a broad particulars column and two amount column. We just write the amount in one column. The other is for our summations and totalings inside it. So now we start solving it. We will look at the format and then solve the statement because it has to be in that structure, right? We cannot look at the statement and solve it because we have to know what comes first. So as per the statement, let's delete some unnecessary items. Manufacturing overhead. I. No, G plus H1. That's fine. Cost of goods sold is G. And this is I. Cost of goods sold is G minus H. Yes, and this is R plus J. Not plus G. Okay. So that is our cost statement structure. Starts with raw materials inventory, period starts. So at the start of the period, what is our raw material inventory? We have to find that thing first. So going back to our problem. Beginning direct material inventory or raw material. Direct material is the same thing. So beginning direct materials inventory on January 1st. That's our item. $6,000. We can write it as it is given in the question. Direct materials inventory. The inner column we write 6,000. Next, we have to write raw material purchases during the year. Whatever direct material, raw material was purchased during the year. That we have here ending direct materials. Ending direct material inventory December 31st is 10,500. We do not need that. We need material purchases, and that is here. Raw material purchase during the period is 50,000. So materials purchase. 50,000, that one we will write here in our problem. Materials purchased 50,000. After that, we need raw materials inventory period end, that is less raw materials inventory. So this is the ending raw materials we have here. Ending raw materials is 10,500 or ending direct material inventory. So in our problem, we write less direct inventory December 31st, 10,500. Okay, 10,500. Next, according to question, we have raw materials used. Raw material used is just the total of these three. And then there is less direct materials used. Okay. Then there is indirect materials used. Let's get rid of these. Straight away come to this. If there is an indirect material used as part of the raw material, then we'll have to write here. So there is no indirect material here. There is material, direct labor, indirect labor, depreciation or manufacturing overhead. Okay, so no indirect material. We'll add these three to create our point number A, that is direct material used. Here. Direct material used. This 10,500 will be subtracted. Answer is 45,500. So direct material used is 45,500. Then we have direct labor. Point number B is straight away direct labor. We have here direct labor 40,000 and indirect labor 15,000. Should we add them for direct labor?
No.
No, right? So what about indirect labor then? Where would that go?
Add the material to direct labor.
Yeah, no, where does indirect labor go?
Indirect in manufacturing overhead.
Yeah, right. Goes into manufacturing overhead. So direct labor will straight away pick from here into our problem. Labor. Now, how much was that? 40,000. 40,000 is the direct labor. And then no, according to the sheet, we have manufacturing overheads now. Every manufacturing overhead goes after this. So first we have indirect labor. So we have indirect labor here 15,000. So all of those might not have been covered in this question. So you just have to look at the problem and find out every manufacturing overhead. Like indirect labor is a manufacturing overhead, factory utilities supply expense is a manufacturing overhead, factory supplies expense is a manufacturing overhead, depreciation, both of them are on the factory units or factory building and factory equipment. So they are manufacturing overhead. And other manufacturing overhead is also a manufacturing overhead. Then you read the sentence below. You are given here. You are also beginning. You also learn that beginning finished goods inventory on January 1st was 20,000. So that's finished goods. Ending finished good inventory on December 31st was 5,000. So that's ending finished goods. Sales for the year was 400,000. That is income. Selling expense was 50,000. That is operating expense. And administrative expense was 75,000. That is also operating expense. So every manufacturing overhead we'll write one by one now. So there's indirect labor 15,000. Then we have these. Factory utilities expense 7,000. Factory supplies expense 5,000. Depreciation expense on factory building 14,000. Then depreciation expense on factory equipment 10,500. $10,500. Then we have other manufacturing overhead 25,000. And that is all. Manufacturing expenses overheads. So we have number C now, manufacturing overhead. Over here adds up to 76,500. 76,000 and manufacturing overhead. All three of them add up to total manufacturing cost. So we have number D here. Total manufacturing cost, A plus B plus C. plus C. Okay, A plus B plus C is 162,000. Total manufacturing cost 162,000. So we are at point D. Next is point E. Work in process inventories. Period start less work in process inventory at period end. So work in process. We have both of them here. That is the beginning work in process here and ending work in process on December 31st. So beginning work in process on January 1st is 10,000. Right, work in process January 1st. Then less process December 31st. That's 9,500. So minus 9,500. That gives us point E, that is cost of goods manufactured, D plus E. Cost of goods manufactured, D plus E. Or is it point F? How comes D plus E? That is point E. So we have point E. So that will be 162,000 plus the 10,000 minus 9,500. Adds up to 162,500. Cost of goods manufactured 162,500. Next we have finished goods inventory. Start of the period. That is point F. Finished goods inventory January 1st. $20,000. Then we have ending finished goods inventory. I think first we have to calculate something else. Okay, we add point E here. So we add to that point E, that is cost of goods. 162,500. We can do without it. Cost of goods available for sale. Okay. That gives us point number G, that is cost of goods available for sale. Cost of goods available for sale, which is E plus F. Then 82,500. Right. Next, you have point number H, that is reduce finished goods inventory on period end. So point H here. Finished goods inventory December 31st. $5,000. Right, minus 5,000. That gives us the cost of goods sold. I got it. G plus H. So it is G plus H. Not G minus H rather, because it's less. $177,500. Next, we'll add operating expenses to it. So all the operating expenses we can find. In our problem, we just have selling expense and administrative expense at the bottom here. Selling expense 50,000, administrative expense 75,000. That gives us our operating expenses. Which is J, 125,000. All adds up to total cost. I plus J. That is cost of goods sold plus operating expense, 302,500. $302,500. Okay, so that's our way to solve. If we wanted to create the income statement as they are asking us, so they are asking to finish the cost statement at cost of goods manufactured and then create an income statement. So we can create an income statement over here below this. Let's create it here. So income statement for Good Vibrations Incorporated for year ended December 31st. And as income statement is created, we have the structure here. Let's bring that structure to. I'll move it into format later on. Right now, let's write the things in income statement. We have sales first. We have sales at the bottom here. Sales for the year $400,000. Everything else is already there. So $400,000 in sales. What is added is here. Gross margin. Gross margin is sales minus point I. Okay, so sales minus cost of goods sold. So 400,000 minus 177,500. That is 222,500. No, 320 or 222, yes. So gross margin is 222,500. Next, we have to get the total operating expense we got, income from operations. Next, we have income from operations, that is gross margin minus point. That will be 87,500. No, 97,500. 97,500. So income from operations is 97,500. That's the income statement. So we just took the sections here from point number F to point number J. You take point F to J and put it in the income statement over here. All you have to do is add sales at the top, gross margin after point I, and you get income from operations after point J. That's your income statement. So this is total cost and this is income statement. Right, that solves that problem. Next, we have anything else? We have problem, alternate problem C here. Yeah, everything looks right. So yeah, let's start solving problem number C then. Alternate problem C on page 21 and 22. Problem C, page 21, 22. Okay, so you guys opened a new store. So is this your third store or fourth store? Albert and Judith.
They have their own business.
Their
sir.
massage clinic, sir.
Sorry.
Massage clinic.
Yeah, so I heard you had two already, right? Or did you have three? Or
They
is
have
this
one in
second
Red
one?
Deer, one in
Oh,
Red
okay.
Deer, one in Brooks.
Oh, so this is the second one. Okay, yeah, congratulations, guys. No, I didn't know Albert and Judith were a couple. I thought, oh, different places. Okay, so let's start solving this one. I think I sent the book to everyone yesterday, and I uploaded on Brightspace too under classwork. So if you see the heading classwork, the book should be right there with it. So the structure of the question is different from the previous one. You have the beginning inventories, that is everything on January 1st over here. Okay, so they've clubbed it together. So don't get confused that you have direct materials here and then direct materials again. Okay, so this is your beginning inventories, all three of them. And these are your ending inventories, all three of them. I think I uploaded the structure also there. It must be called the cost accounting solved problems. Maybe you can find it on. Let's say, otherwise I'll put it now. Okay, now you have the file. Cost accounting solved problems.
Thank you, sir.
Okay. So alternate problem C says Presley Manufacturing Company is a producer of music compact disc, CDs, and tapes. The following account balances are for the year ended December 31st. So we have the cost, Nestle Manufacturing. For the year December 31st. So first item, we need raw materials, start inventory, purchase, and inventory. Beginning inventory January 1st, direct materials. Materials inventory January 1st is 14,000. Then we have direct material purchases. Direct materials purchases here it is 216,000. Next we have reduced from this less. On December 31st. Ending inventories, direct material is here. $44,000 minus 44,000. That gives us direct material used. There is no indirect material. No indirect material included here. So we have point A. Direct materials used. Direct materials used is addition of these three, 186,000. Then number B, direct labor. When number B, Direct labor is over here on the top. 468,000. 468,000. Next, we will have manufacturing overheads, all which we can find. So administrative expense is not a manufacturing overhead. It is an operating expense. Depreciation expense on manufacturing equipment is a manufacturing overhead. So depreciation expense on manufacturing equipment. That's 50,000. Direct labor is direct labor. Manufacturing supplies expense is manufacturing overhead. Manufacturing supplies expense is 40,000. Next, we have indirect labor. That is also manufacturing overhead, 36,000. 36,000. So we have beginning inventories, ending inventories, nothing to do with the manufacturing expenses or manufacturing overhead. Direct material purchase belongs to material. Rent expense is a manufacturing overhead. We'll take that. Rent expense factory 28,000. 28,000. Sales is a income. Selling expense is a operating expense. Other manufacturing overheads are manufacturing overheads. So next is other manufacturing overhead 126,000. 126,000. We get number C. Manufacturing expense. Oh, sorry, manufacturing overheads. So what is it called? Manufacturing overhead. Manufacturing overhead is 280,000 in total. Next, we get by adding A, B, and C total manufacturing cost. So D. Yeah. Total manufacturing cost is 934,000. Next, we'll have our work in progress, opening and closing, which will give us the cost of goods manufactured. So we write work in process. Work in process. January 1st. So beginning inventories work in process on January 1st is 20,000. 20,000. Then we have less work in process December 31st. Work in process on December 31st is 56,000. So minus 56,000 gives us point E. Cost of goods manufactured, is it called? Cost of goods manufactured. Which is 800,000. Then we'll have our finished inventory and cost of goods sold. So we have our finished on finished goods, they are called finished goods 128,000. Finished goods inventory period start. Then we add cost of good manufactured and we get cost of goods available for sale. We can straight away write here cost of goods available for sale. If we want, that is okay. So this is point G. Cost of goods available for sale is E plus F. We already have our E. Adds up to 1,026,000. We reduced finish inventory and we get cost of goods sold. cost of goods available for sale, then we have less finished goods December 31st. Finished goods ending inventory is 92,000. So minus 92,000. That gives us cost of goods sold is over here. It is 934,000. Then we have selling expense and administrative expenses. That is our operating expenses. Sorry, operating expenses. Do we have anything else? We have our administrative expenses here. On top, 60,000. Administrative expenses, 60,000. And we have selling expenses, 72,000. Gives us operating expense point J. $132,000. The cost adds up to 0.5. Plus J. $1,066,000. 1,066,000. Okay, so that is done. Let's take our break. We'll come back from break and make the income statement for this problem and then move to other problems. Let's come back at 10:15. Okay, now we create the income statement for this. So this was cost statement and now income statement. Starting with sales. Sales for the company are 1.4 million. And we just bring this section over to income statement. All of this. We have gross margin here. Sales minus cost of goods sold, that is I. So gross margin is sales minus the cost of goods sold. 466,000. We have last income from operations is 466 minus 132. So 334,000, that's our total income. So any more examples of this you can solve? Unsolved examples, unsolved. Okay, no examples available anymore. So that was our final example. I will try to search for new books if they are available. They should have more examples in them. Manage email account. Just give me 5 more minutes. I'll find something. My computer screen has turned off. I'll just need 5 minutes. No, I believe that's all the examples we have for cost sheet. So we did 3. Now we'll be moving to different types of costing. Like this was all for manufacturing costing, or when a manufacturing plant or manufacturing unit is involved. Further after this, the syllabus is moving to job costing, activity-based costing, process costing in every book I see. Nobody else has a problem solved for cost statement. So that's our basic preparation before we move on to other sections. Other things that can happen in this statement is sometimes they will give you units and you just have to put the unit column in front of your amount column. So let me show you that on screen. Sometimes it may happen that you will get a unit here, or the publisher or the question will mention a unit. Okay, about now. So if they give you a unit, in that case, you just have to calculate the cost per unit. So you will get your, let's say, direct material. Direct material used will be a amount in the outer column. All you have to do in that case is divide that amount by the number of units, or the number of units manufactured. So you will get per unit for that. That's the only variant or variation we have in cost statement. So this is the most generic one for a manufacturing company. what the syllabus moves forward is to job costing, process costing, and activity-based costing. So if somebody is manufacturing a service unit, if somebody has a contract manufacturing business like house or airplane, such kind of things, if they are manufactured, then they use the other systems of accounting. Okay, RAM problem there. Okay, so this is what will happen if you are asked for a unit, then they will the question will say units, let's say 1000 units here. Then what is the cost per unit? In that case, you just have to divide everything by the number of units. So the material used per unit will be 186 because that's 186,000 units. Direct labor will be 468 because for 1000 units, 468 is the material per unit.
Sir, excuse me, your screen is not working.
Not working? Okay. Wait, I'll stop and share it again. My computer just got hung up for a few minutes there. So is it working now?
Yeah, it's okay now. Thank you.
Okay. So in those cases, you just have to mention here that these costs per unit are written in such a way. So because there are 1000 units, it becomes really easy. You just have to reduce 3 zeros. So 934, 932, 1066. So this statement will just show that your total cost for manufacturing every unit was 1066, whatever it is that company is manufacturing. So after this, they move to other systems of accounting, or the book proceeds. And the first system is job order costing. Okay, job order costing is when you get a contract or you get a job order for different things. You do in these cases you do job order costing. So let's look at the job order costing system, and then we'll go for these problems. So the characteristics of the job order costing system are there is a physical flow of goods, that is material in the storeroom to the production department to the finished goods storeroom. I think it should be more clearly visible now. So these are the characteristics. Physical flow of goods is material storeroom, it moves to production departments, then it moves to finished goods storeroom where your finished goods are, while after that it's delivered to customers. The flow of money is material inventory is bought, work in progress involves your direct labor and manufacturing overhead. Then manufacturing overheads and direct labor are worked on your raw material, which converts that into a finished inventory. So you get your finished inventory after this, and you get the cost of goods sold. That is how much it costs you to produce those goods. So work in progress, we already know that is the work in process that we called in our statement. So if you look at the cost statement again, it is going through the same process. right? We have the material coming in, that is raw material. We apply direct material, direct labor to it, and other manufacturing expenses. We apply all of those, we get a total manufacturing cost. Okay. And after that, we have some products that are still under the process of being manufactured, while some are already produced. So you get all of these things in your manufacturing. Until here, you have your manufacturing still going on. That is, you put in all the expenses and materials. Goods are either finished or not finished. Once they are finished, they come into this stage below the line, that is finished goods. And then those are sold away. So it's the same process being followed in the cost model. So these are the kinds of companies that are using job costing. So the type of production they have and accounting system they will use. Sorry, not job, but job and process costing. For example, the first is a job shop. Job shop is you get one contract and you have a cost for that contract. For example, a hospital is again example of the same thing. Every patient is treated differently. They are not treated the same unless they have the same problem. So if every patient is treated differently, it becomes a job costing system. The hospital has to calculate their cost for every customer also. So we have hospital, custom home builder, and consulting firms. These are job costing systems. Then batch production is also job costing. For example, if there is a furniture manufacturer or wine manufacturer would, like wine is normally produced over years. The wine manufacturer would extract the wine from fruits and then store it over a long period of time. So it is one job, then the other job. So every unit is treated as a different contract of job. Then the second two are process costing system, or process costing that includes repetitive manufacturing, which is the one we saw earlier. Repetitive manufacturing is where you have an assembly line, you're producing one thing, same again and again. That is, examples for that are computer manufacturer and bicycle manufacturers. Then we have continuous flow processing. Flow processing is same thing as repetitive manufacturing, only that the product flows out instead of being created in units. For example, oil refinery. Oil refinery doesn't produce like 1 liter of oil at a time and then gives it out. No, the oil is manufactured consistently. So that is a continuous flow manufacturing. So right now we are looking at job costing system or job order costing. Now the book goes through journal entries for job costing, which we are not going to look at the journal entries. They will just confuse the process for you. So as they say here, subsidiary ledgers needed for job order costing. So when the company makes financial statements, they use ledgers to support it. Job costing process with journal entries, as they call here. We can look at that, but mostly it would be confusing. So they are looking at the same thing here. Raw material inventory, accounts payable, debit. Let's see if they have similar problems. Yeah, they have one. Isn't this the same one that we solved before? Yes, the same one. Okay, so we will not look at the ledger entries or the journal entries for that. We will come directly to the job cost flow or the job costing system. So what is a job costing system? A job cost system accumulates cost incurred according to individual jobs. Okay, so let's say if you have 3 jobs or 3 manufacturing lines in a company, or maybe 3 contracts to a company, then there will be 3 individual jobs for you. Uh, Most common example for this is house building. So if the company is building 3 houses, each to the specification of the new house owner, then there are 3 jobs or 3 individual jobs available before the company. And in that case, they will apply job costing to each of those projects. So companies generally use the job cost system when they can identify separate products or when they produce goods to meet a customer's particular needs. So as they are designed as per their needs, they will use job costing system. Who uses job costing? Examples include home builders who design specific houses for each customer and accumulate the cost separately for each job. The caterers who accumulate the cost of each banquet separately. Consulting, law, and public accounting firms that use job costing to measure the cost of serving each client. Motion pictures, printing, and other industries where unique jobs are produced use job costing. Hospitals also use job costing to determine the cost of each patient's care. So this is the flow chart used to record transaction in job costing. So expand this. But this is again for the journal entry of that of job costing. Job costing account flow for journal entries. Let's expand this. So we have our 3 heads here. That is a raw material inventory, the direct material that we use. Then the factory payroll is the direct labor used. And then there are manufacturing overheads. All of these 3 add into the work in process inventory. So when the work is in process or when the process is going on, all these 3 things are involved. Your raw material is involved, your labor is involved, and other expenses or overheads applied to it are also involved. All of them work together to complete the job and thus create the finished inventory. So we get the finished inventory that gives us a cost for that inventory, which is what we did before. So when we do journal entries for that, we do entries for each letter labeled in the chart. Where the arrow is pointing to is our debit, and where the arrow is coming from is our credit. So arrow pointing to and arrow coming from Will make it easier to understand. So arrow coming from is where the money is coming from and where the money is going to. As we remember for journal entries, it's only the money that we record. We do not record anything else. So journal entries, we are not going to look at the journal entries. We will keep our syllabus to only the cost sheets of these examples. So here is an example of job costing that they have given. That is for Assume Creative Printers. Printers, they use printing jobs or they do printing jobs for customers. What they have shown here is the small costing sheet, a very small version of the one we are used to. Then they have explained the journal entries for that. So we are skipping the journal entry part because that will just create a lot of confusion in this. So we are just to learn what how costing is done, not to look at journal entries. For example, I can show you the journal entry or how they are done. For example, the one you're looking at is journal entry G. So this journal entry is for overheads. The overheads of the company includes all of these items up here. That is machinery repairs, utilities, depreciation, other overhead. They all add up to be the overheads of the company. Then they give an explanation. To prepare the journal entry, we debit the overhead account for the actual cost. Then we credit the accounts payable for machinery repairs, utilities, and other overhead. We assume that outside contractor does the maintenance and repair. So the amount is 4,300. And finally, we credit the accumulated depreciation 2,500 because accumulated depreciation is a liability. So it is credited. So what they did is they looked at the overheads. First one is machinery repairs and maintenance, which is you paid cash for that. So obviously cash will be credited or accounts payable. So they here used accounts payable because we do not know if they paid in cash or they did not pay. But obviously for machinery repair, there would be an outside contractor. For utility costs, that is energy cost to run the machines. Also, you have to pay money. So that will be also cash credit. So all instead of these accounts payable, we could have very well used cash because some companies may pay the amount in cash. Then we have depreciation. Now depreciation does not involve cash because depreciation is just an expense applied on your machinery. It is not money you gave to somebody. So that's why we do not put that in cash. That is put into accumulated depreciation. Whereas other overheads can be also put into cash. 1,800. So 4,300 cash credit and depreciation 2,500. Could be another way to solve this one. And our debit will be the overheads. That is expenses that we incurred. So those are journal entries, but we will skip that part. We'll come straight away to actual versus applied factory overheads. So this is the part we have to learn. So looking at this actual versus applied factory overhead. By definition, overhead cannot be traced directly to jobs. So most of the overheads, they cannot be traced directly, like electricity expense for the manufacturing plant. Now you will get a combined electricity bill for the complete manufacturing facility or the manufacturing plant. You won't get a manufacturing bill separately for assembly line 1 and assembly line 2. There is just one electricity bill for the whole company. So it becomes difficult to apply that electricity bill to manufacturing line 1, 2, or 3 if you have multiple lines. So that makes it difficult to trace overheads directly to the jobs that you're doing. Most companies use a predetermined overhead rate or estimate rate instead of actual overhead for the following reasons. So they will use an estimate. One of the reason is if you have 3 manufacturing lines inside the plant, instead of knowing the electricity consumed by each manufacturing line, you can just divide the total electricity bill by 3. If you have 3 of them running all the time, then they can be divided. Or some companies may use a separate electricity meter, measurement meter for every production line. So if the electricity supply for the 3 production lines is separated, the companies can very well use 3 separate counting meters. Okay, so for that reason, it becomes complicated and you have to put an estimate for that. Now, the reasons they have given here are further, a company usually does not incur overhead costs uniformly throughout the year. So some overhead cost or some factory costs are not uniform throughout the year. For example, heating costs are greater during winter months. However, allocating more overhead costs to a job produced in winter compared to one produced in summer may serve no useful purpose. So since you cannot increase the prices of your product in winter because it is costing you more to produce and reduce the prices in summer because it costs you less, you just have to take one estimated cost for it throughout the year. For example, when you're making a house budget for how much electricity bill you have to pay. Now we know that the electricity bill can go from like $300 in summer to $600 in winter. So we know that on average, our electricity bill is going to be around $400 to $450 because but that is an estimate. The actual figures are different, but we just know that half of the year it will be high and then a half of the year it will be low. So that's the reason we take estimate. Second reason is some overhead costs like factory building depreciation are fixed cost. So since depreciation is fixed cost as allowed by the government, what the government tax rules do is they will allow every business to charge depreciation on their equipment for the year, and they will have a cap on that. So for example, the government will say that you can apply 20% depreciation per year or 15%. So for your business, that becomes a fixed cost. Now, no matter how much you produce or how much production you do, or how long you run the machinery, the depreciation on that is going to be 20% of the cost. So if your production plant runs for one shift per day only, that is 8 hours per day, you still have the depreciation at the same level as somebody who is running the production plant for 16 or 24 hours per day. So again, because of that, you cannot attach the depreciation to one product. When the production is high, then depreciation per product will be low. And when the production is low, then the depreciation will be high. Then predetermined rates make it possible for companies to estimate job costs sooner. Using a predetermined rate, companies can assign overhead cost to production when assigning direct material and direct labor cost. Without a predetermined rate, companies do not know the cost of production until the end of month, or even later when their bills arrive. For example, electricity bill for July will probably not arrive until mid-August, maybe. If Creative Printers had used actual overhead, the company would not have determined the cost of its July work until August. It is better to have a good estimate of cost when doing the work instead of waiting a long time for only a slightly more accurate number. So what the companies will do is they know from previous experience what the cost is. Okay, so let's say something like this comes up, that you have a t-shirt manufacturing company, and suddenly a customer places the order for 5,000 t-shirts. Now the customer is putting out a tender, and everyone has to submit their prices as to at what price they can supply the t-shirts, that is 5,000 t-shirts. So in order to give the customer a price, that is this is the price I will supply you the 5,000 t-shirts at, you have to first of all know what the cost of t-shirt is to you. And since you have not produced the t-shirts already, how will you know what the costs are? So in that case, the company will use estimates that in the past, this is what one t-shirt has cost me. So in the future, it should be the same, around the same. So in the future, it should be around the same number of same cost per unit. So that's the reason why companies have to take a predetermined rate. So companies will assume that, yeah, this is the month of December, and last year in December, I had so and so electricity bill. So I would assume that will be the same this year. Because it doesn't serve a purpose to produce the t-shirt and then wait for the price in order to quote the customer. So we have predetermined overhead rates. These rates are used to apply overheads to jobs until we have all the actual costs available. To create the rate, we use cost drivers to assign costs overhead to jobs. A cost driver is a measure of activities such as machine hours, that is the cause of cost. To assign overheads to job, the cost driver should be the cause and of the overheads cost, or at least be reasonably associated with the overhead cost. So in order to determine the cost beforehand, or in order to predetermine your cost, uh, what they say is we need a cost driver. Cost driver is something that is something that you spend money on. During the production process, something that requires money is a cost driver. And then you can measure the activity of that to determine what the cost would be. For example, if the cost driver is a machinery for textile plant would be, let's say, the stitching machines or weaving machines. So they take the cloth in vertical lines and horizontal lines, and then they weave them together. Okay, so that becomes a cost driver. And if you know how much electricity it consumes and how many hours it ran for, then you can easily determine what the machine hour cost or what the cost of that cost driver is. So just as automobile mileage is a good cost driver for measuring the cost of gasoline consumption, machine hours is a measure for what causes energy cost. Okay, so what is the reason for energy cost? Is because of machine hours. By assigning energy cost to jobs based on the number of machine minutes or hours the job uses, we have a pretty good idea of the energy cost required to produce the job. So what they're doing here is, if you take any electrical appliance in your house, okay, they will have an energy rating and they have a voltage consumption as to how many voltage or amperes of electricity this particular appliance is going to consume. And those things are in the basis of time. They will be mentioned in time, that this is the units of electricity it will be consuming in 1 hour, could be more or less the same. So technically you can use that to determine in a month how much electricity you will be using. For example, you have an oven in your kitchen. Okay, the oven runs at generally, let's say 420 degrees Celsius. Okay, is it Celsius or Fahrenheit? Fahrenheit, sorry. So the oven runs at 420 degree Fahrenheit, and the machine states that to run at this temperature, this is the amount of electricity it will be consuming per hour. And if you then run the oven for, let's say, 1 hour per day for 30 days. So given that usage the oven will do and the price of electricity in the market, you can determine in a month how much electricity that oven is going to cost you. Okay, so most manufacturing and service organizations. Most manufacturing and service organizations use predetermined rates. To calculate the predetermined overhead rate, a company divides the estimated total overhead cost for a period by an estimated base or expected level of activity. This activity could be total expected machine hours, total expected direct labor hours, or total expected direct labor cost for the period. Companies set predetermined overhead rates at the beginning of the year in which they will use them. This formula computes the predetermined rate for everything. Actually, you have any rate, they will be calculated by the same formula. So predetermined overhead rate will always be estimated overhead divided by estimated base. So estimated overhead and estimated base. The easiest way to explain this is as we have seen the formula for inflation in economics. So when we were studying economics, there was this formula for inflation. Inflation is calculated as a percentage given a base year. A base year meaning you have a pre-established or a known level of activity. That is, this is the level of activity. And then the overhead is how much actually happened this year. So you comparing one level of activity to the other to determine the predetermined overhead rate in this case. So I know it is confusing. Yes. So let's go through that again. A company divides. A company divides the estimated total overhead cost. So what is the total overhead cost for a period will be divided by an estimated base or level of activity to give you a predetermined overhead rate. So level of activity in this case could be how can I say that, like how many units will be produced per unit of time will be your level of activity. Or yeah, how many units, let's say it's 5,000 t-shirts that you have a contract for, then your level of activity becomes 5,000 t-shirts, and estimated overhead is how much of an overhead you will need for the 5,000 t-shirts, or then you can determine what is the overhead per t-shirt. So yeah, as we reach the examples below this, it will become more clear as to what the predetermined overhead rate is. So this is the formula for predetermined overhead rate as to this is what you're gonna spend on one unit when you're into the activity. Okay, so to apply overhead, then to apply overhead, we use the level of activity that we know or the actual amount of the base to the predetermined overhead rate. So when we multiply the predetermined overhead rate we calculated before to the actual amount of activity we have, we get the applied overhead or what's actually our overhead for that period. So the example here says, let's say Creative Printers estimated a overhead related to machine usage. Okay, so they think machinery usage costs them $120,000 every year. Okay, so there is $120,000 machinery usage in a year. And the estimated machine usage for the year is 60,000 machine hours. So the company spends $120,000 for machinery usage. That is the repair and maintenance of the machinery, the electricity consumed by the machinery, and the other inputs into the machinery. So you have $120,000 for the year spent on machinery, and the machine works for 60,000 machine hours. Now, how does a machine work for 60,000 hours? Is they don't have one machine. The company would have multiple machines. So adding up all their hours, the machinery are working for 60,000 hours in a year. So that means that per hour, that machine is consuming $2. Or as shown here, the predetermined rate would be estimated overhead, that is how much you are expecting to spend over the period, divided by the estimated base. That is what activity are you actually measuring that against. So our estimated overhead is $120,000, and we are using that to measure how many machine hours, the cost of machine hours. So we are determining the overhead rate for running the machinery for 1 hour. So that will be done with $120,000. That is our yearly cost divided by the number of hours the machine runs. So that says that $2 per hour per machine is spent or on the machines are spent. So now you can apply this overhead to jobs. That is job 106 and job 107. So job 106 here says that there is 875 machine hours required to produce that job. For example, this could be something like, let's say somebody places an order for 1,000 t-shirts. Then the company determines that for producing 1,000 t-shirts, we will have to run our machinery for 875 hours. Okay, mentioned here, that is job 106 is 1,000 t-shirts. We are assuming that, and it says that there are 875 machine hours required to produce 1,000 t-shirts. So then that gives us the cost of overhead for the 1,000 t-shirts. All we have to do is 875 machine hours multiplied by 2 will be the answer for how much machinery overhead will be spent on producing 1,000 t-shirts. So here it says like job 106. That is, you are running the machinery for 875 hours. The predetermined overhead rate for machinery is $2 per hour. So since we are going to be charged $2 for running the machinery for 1 hour, your job is going to cost $1,750 on the overheads. So this is not including like materials and labor. This is just overhead. So we now know that we now know that for 1,000 t-shirts to be manufactured, there will be 1,750 in overhead cost. Then job 107 says 4,050 hours are required. So let's say there is another job created for 5,000 t-shirts. Okay, so 5,000 t-shirts, we know that will require 4,050 machine hours. Okay, so that requires 4,050 hours multiplied by 2 is 8,100 hours. $8,100, sorry. spent on overhead costs for 4,050 t-shirts. Okay, so what we are doing here until now is an estimate. We made up these numbers. Okay, the POHR is a made up number, but very important. That does not make it any less important for the business. Now it has to be predetermined in order to estimate your delivery cost. And we are all used to this. It is just that we are for the first time looking at it in the form of a mathematical formula. So if any of you guys has done deliveries with Skip the Dishes, DoorDash, Uber Eats, or if you have done taxi services with Uber or any other delivery service like with Amazon or others, you already know what is happening here. Like when I used to do delivery with DoorDash, I would determine how much dollars I have to spend on doing that delivery. For example, I had an estimate that my vehicle costs me 10 cents for every kilometers. Okay, so there are 10 cents to travel every kilometer, and I can just multiply that with the number of kilometers I have to go. For example, if a delivery said on my app that I will be paid $8 and the delivery is 6 kilometers away. So $8 to deliver a food 6 kilometers away. Now I have in my mind an estimate that my per kilometer cost is 10 cents. Okay, so per kilometer 10 cents is the cost to me, and I have to go 6 kilometers. So that will be 60 cents. Plus, I assume that I may have to come back 6 kilometers to take another delivery. So that makes 6 times 2, 12 kilometers. So under that case, I know my fuel cost for the vehicle is going to be 12 times 10 cents. That is $1.20. So this is an estimate I made up in my head for my costing or cost analysis. So I would do that always whenever I receive a delivery. So that would help me determine is the delivery worth my time or not. So I would just assume like, so in this case, 12 kilometers, $1.2 for your fuel. And let's say other maintenance and other expenses for the vehicle, it's $1.5. So $1.5 to complete this delivery, and they are paying me $8. So $8 will leave me with $6.5 for this delivery. If I think it is worth it, I would go for the delivery or I would not. So this is just an example of how we are using job costing in our own mind to do business. So every businessman will do that. Okay, so same delivery, if somebody was paying me $5. So if the DoorDash app said that I'm paid $5 for 6 kilometers, then I would again think like, okay, $1.5 for the delivery, and they are paying me $5. That leaves me with $3.5. So I have $3.50 after the delivery. And I think 6 kilometers going and delivering, coming back will need at least like half an hour to 40 minutes. So why would I want to make $3.5 in half an hour? I would just reject that order. So I can think about making $6 to $7 in half an hour. That would be reasonable, but $3.50, that is not reasonable. So in the first condition, when the delivery is paying me $8, I will take it. In the second condition, when they are paying $5, I will not take it. So what I did was something same. I created a predetermined overhead rate in my head that generally my vehicle costs 10 cents for every kilometers. 10 could be 12 cents, near in that range. So I estimated it then $10, 10 cents per kilometer. That is my predetermined overhead rate. Okay. So my estimated overhead divided by base. I created an estimate for myself, and then I applied that estimate to the actual machine, to the actual job I'm going to do, to determine how much cost it is going to cost me. So that is the same thing company is doing here. Based on past experience, they determine that they spend $2 per machine hour on overheads. Let's say the overhead here is only utility bill or the electricity bill. So the company estimates that the number of machines that they have, maybe 3 or 4 machines, they are spending $2 every hour for the machine runs. So now they know the cost of running the machine for 1 hour. They can then apply it to their job. Let's say one t-shirt requires maybe 1 hour on the machine to manufacture. Let's say one t-shirt requires 1 hour. So that means that every t-shirt has a $2 cost of the running the machinery on it or the electricity on it. And that's really helpful with costing later on. Once you know that these my costs are, these are my costs. Company can do something similar. Let's say they are paying labor by the amount of job they do instead of by hour. So if a factory pays the laborers by the amount of job they have done in a particular time period, instead of paying them by the hour, then they can determine how much the cost of producing one unit is. For example, if you say to the laborers in the company or the people who work on the assembly line that instead of paying you $17 per hour, I will pay you $8 for every t-shirt completed. Okay. So every t-shirt completed, the labor or the manufacturer assembly line worker will be paid $8. So that makes it really easy for the company to estimate what the cost of the t-shirt is. Now they know the machinery needs $2 per hour to run, and it produces one t-shirt in an hour. So that's $2 per t-shirt. $8 for every assembly line worker working on the t-shirt. That makes it $10. Then we only have the raw material. The raw material would be with the company, and they can estimate further what's the cost for raw material. So let's say it requires $30 worth of cloth to produce one t-shirt. Okay, so $30 of cloth, $8 of labor, and $2 of electricity makes it $40. So the company makes an estimate at this stage that it costs me around $40 to produce one t-shirt. And based on that estimate, this is not what actually is going to happen. They are estimating it. And based on that estimate, they can then apply for a contract. Or they can say that, yeah, it saves me money or makes me money to sell at any price above $40. So depending on what the size of contract is or how many t-shirts are dependent, the company may quote a lower or higher price for that, right? So that's how predetermined overheads are created, and then they are applied to actual overheads. So there is a paragraph here about actual overhead. There is not much calculation because actual overhead nobody knows. Actual overhead are only known after the job is done. Okay, so they are not of very much use in cost analysis. They might be very useful in statement of cost preparation, but during for making predetermined cost, they are not very useful. So actual overhead. Actual overhead costs are the true cost incurred and typically includes things like indirect materials, indirect labor, factory supplies, factory insurance, depreciation, maintenance, and taxes. So actual overhead costs are indirect, are any indirect cost related to completing the job or making the product. Next, we look at how we correct our records when the actual or applied overhead do not match, which they almost never match. So this we're going to do tomorrow under and over applied overhead. I will better look for some more problems for us to solve rather than looking at the journal entries for these things. So I'll just mark your attendance first before I finish for today. And hopefully I have more examples now. So we have everybody here. Okay.
Sasabi ko na lang kay John sa birthday tsaka engagement.
Wow! Social. Magpapa-bachelor party pala tayo.
Hello.
Okay, Reline is not here, right? Has Reline moved to another class? Okay. So one thing before we end, the college was asking that the students that are left with only Microsoft Office, so that have done every other module and only Microsoft Office is left for them, they have to they can email their name to me and I'll put them before college. So that's the only thing left. I think you guys still have one more module to go, that is income tax. Then there will be Microsoft Office. So is there anyone in class who only has Microsoft Office to go after this module? Everything else is done for them. Or who has done income tax module also? Nobody, right? Okay. I'll just tell them that there are more modules to go before you are only left with Office.
So, sir, we have like 5 modules left.
Yes, I think most of you have left, right? Okay. So those students must be in other classes then. And yeah, that does attendance for me. So I was really hoping we could do more example today, but I unfortunately couldn't find anything else. So we had to move starting into the next chapter. I will anyway look for more example or any book I can find where that has the simple cost statement and other statements. And we'll try to stay clear of the journal entries again. Okay, so we'll meet tomorrow morning, then we'll move ahead with this chapter, that is job order costing. And as many cost statements I find, I'll bring them and we'll practice those.
Yes, sir.
Okay, so yeah, see you tomorrow.
Thank you, sir.
Okay, bye.
Bye, guys.
Bye.
Thank you, sir.
Guys, have a good day. everyone.
Bye, sir.
Bye.
Bye, classmates.
Bye.
Bye.